Today, I'm talking with Frank Vasquez. Frank is a retired lawyer with degrees in economics and engineering from Caltech and a law degree from Georgetown. He runs a great podcast called Risk Parity Radio, where he discusses risk parity investing concepts for do-it-yourself investors. On the podcast, he covers core investing concepts, and then he also answers questions from the audience. Welcome to the podcast, Frank.
Thank you. Thank you for having me.
Thanks for coming on. So how did you first become interested in investing?
Well, let's see if we can keep this story short enough so your audience doesn't fall asleep. I went to college back in the 1980s and graduated with degrees in engineering and economics. Thought I might go on in economics, but decided to just on a lark go to law school, which ended up being an interesting choice for a career. But then I really didn't have much of any money to invest until actually I got out of law school and got a real lawyer job. And at that point, I was very interested in actually futures. And so traded futures contracts for a few years, which was interesting. It was a lot of work, particularly at that point in time, because I was literally manually entering the data into programs that I wrote myself.
Wow.
And determined that, I could make some money off of it. I was making the equivalent of, say, 10% a year. But it was too much work. And once I started having children, that needed to go by the wayside. And I realized that, at the time, the best use of my finances were paying off debts and just doing the ordinary, put it in your 401k type stuff. And so continued to build that out and build out a family. But it came to a time right around between 2008 and 2010 when I kind of realized, okay, we're going to reach, financial independence sometime in the next decade. And, it was sort of like, well, what do I'm 44 years old at the time. I was like, what do I really want to do with myself in terms of life and investing and everything else. And so at that time, it was right after the financial crash. I've always been interested in investing, always read about investing, but I just kind of followed the basic trends, which were in the 1990s, it was Peter Lynch, pick your favorite, fund manager and try to figure out who that was. And then early 2000s, that transition into index investing, bogleheads, that sort of stuff. But it got to 2010, and I'm looking at, well, what do I really want to do for sort of our portfolio when I retire? What does that need to look like? And I was very dissatisfied with sort of the common things that were thrown out there. I remember reading this book by Lawrence Kotlikoff, who is still out there publishing books, who recommended, and this is about 2005 or 2006, a portfolio that was 1/3 total stock market U.S., 1/3 total international stock market, and 1/3 U.S. tips. And you can imagine how horribly that did in 2008. And it was those sorts of ideas that I just knew that there was not good information out there. And I felt that there on the personal finance side, there had to be better information. And so when I started researching, and this was at the time when it was much more difficult to do research. I mean, you had books you could buy at the bookstore about personal finance and stuff, but the kind of information that we have today, and I'm talking about white papers from hedge funds and academic papers, were not very accessible or findable. And so I ran across, by happenstance, around 2011, the early sort of papers that Bridgewater had thrown up on their website, and they had this really primitive website there. And Ray Dalio had published this 100-page memo, which was kind of like the first draft of his book, Principles, in retrospect. I can't find this thing anymore, but I wish I could. But half of it was like how he managed his business and those sort of radical transparency issues and things that he's known for. And then the other half was just basic principles of investing, including what he called the Holy Grail principle, which is essentially really focusing on maximizing diversification as a core principle for investing. And there's a nice little video that I can link you to. It's 5 minutes long. He explains this on a whiteboard, but it's just that basic concept, which he refers to as the holy grail of investing, and I call that the holy grail principle. And so that idea was what then motivated me to sort of, well, how do we do that? And so one of the things I read his stuff, and then I read stuff about the permanent portfolio, and I went back and found Harry Brown's books from the 1980s and read those, and a variety of other things. And then other papers and things from AQR and other places became public and were accessible. It was also, so I was sort of fiddling around with sample portfolios. This is between 2010 and 2015. The problem being there was no good way for an amateur investor to analyze these things in any meaningful way. We just didn't have the tools. Around that time, though, one of your other guests, Tyler, came out with what is called portfolio charts, where he had assembled a whole pile of data, put it into spreadsheet form, and then created graphical representations of that, which allowed you to go in and analyze various kinds of portfolios. Shortly after that, Portfolio Visualizer came out, which was another huge data set and set of tools for individual investors to really do those sorts of things. And so with those tools, I was able to construct sort of better, more diversified portfolios. And when I was thinking about what kind of portfolio do you want to hold in retirement or to be living off of or decumulating out of? And I concluded from that the really what you were looking for is not in an accumulation portfolio. Obviously, you're just trying to accumulate as much as possible over some lengthy period of time. When you are trying to draw down on a portfolio, though, what's more critical is how much you can take out of it, which is reflected in what is known as the safe withdrawal rate or the projected safe withdrawal rate. And so that is a different measure for every portfolio. One of the nice things about what Tyler's work at Portfolio Charts revealed was you get different projected safe withdrawal rates based on what kind of portfolio you hold. And it wasn't intuitive necessarily as to what combination of things worked best. I've said on my podcast that, so my background's in material science as far as engineering is concerned. It was like, as a material scientist, that you can make various kinds of steel or other materials, but you really don't know what the properties of it are going to be until you make one and then go break it and test it. And so this was a way of kind of doing that. Well, let's put in different kinds of portfolios and to see what kind of safe withdrawal rates are generated out of those things over long data sets and periods of time. And so it was those two ideas that kind of led me to where I am now with the kinds of portfolios we talk about on my podcast. So basically, if you listen to the early podcasts, I kind of lay all this out in the first 10 or so. That I'm looking at three principles. One is this holy grail principle, which is the main one about diversification. And then for a do-it-yourself investor, I also look at two other principles. One of them is called the macro allocation principle. And this one is best expressed if you go and read Jack Bogle's Common Sense Investing. Go to the end of the book, read chapters 18 and 19. And what is in there and what is revealed is a lot of research showing that if you compare a bunch of portfolios or a bunch of managers, if you look at the macro allocations, basically the stocks, the bonds, and whatever else you have in there, all portfolios with the same kinds of macro allocations tend to perform relatively similarly. So what that tells you is that is a main decision point in your portfolio construction is, well, what is the overall percentage of stocks? What is the overall percentage of bonds? What's the overall percentage of whatever else you're putting in there? And then another one I use is the simplicity principle, which is let's make this as simple as it can be and still work, essentially, because most people, going back to my time trading futures in the 1990s, don't necessarily have the time or inclination to implement a complex strategy. So coming up with something that that works well enough that you can manage is important for somebody who is doing this yourself. And so that principle really comes from people like Rick Ferry, who says this.
Mm-hmm.
This was one of the principles that Paul Merriman learned when he went and saw Jack Bogle, because he went there and Bogle said to him, this is like 2017 before Bogle died, and he says to him, I really like what you're doing there with your foundation and these portfolios you created, but what you created is just way too more complicated than other people can handle. So why don't you come up with simpler versions of this? And to his credit, he has in the past 5 or 6 years come up with very simplified versions of things down to 2 funds in an accumulation portfolio. But I think about that when I'm thinking about portfolio construction as well. But now I'm probably droning on much too long for your listeners. So
no, it's great. I'm just letting you roll.
You can see why I can run a solo podcast fairly successfully.
Yeah. I love how when you started investing, you go right for the hardest thing imaginable. Like, I'm going to trade options contracts. I think that's awesome.
It was fun. It was exciting, but you had to do it. You did it over the phone. I mean, there was no internet.
Oh, wow.
So, I was calling up my broker every morning about, what's going on out in coffee land or cocoa or the crude oil or whatever else I was trading.
Like trading places kind of.
It was exactly like that. And I remember this one day, most memorable trade. Her name was Lisa, and she calls me up and says, there was a freeze in Colombia. Just shocked.
You needed a crop report.
So I made like $10,000 on this one little contract trade.
Awesome.
It was really a lot of money for what I was doing at the time. And so, you're still able to do things like that, but you did almost have an advantage because it was so hard that if you were willing to put in the work, you could come up with basic trend following systems and things like that. But what's interesting to me about that is now we're coming full circle with respect to things like managed futures, that they're now more accessible to do-it-yourself investors, which they really weren't tradable for most people in the past forever.
Right.
Until very recently.
Right. And so something else I thought was interesting is you and Tyler are both engineers. And I love that engineers bring such a good mindset to investing, I think, because they're saying like, well, what is the evidence? Prove that works. Because so many things in investing are like, you hear this compelling story and it doesn't necessarily reflect reality.
Yeah. So much of investing relies on sort of guru worship, or the appeal to authority is the fallacy involved.
Mm-hmm.
Engineers tend to want to look under the hood and say, okay, you say that works. Why do you say it works? What is the evidence that it works? What about other options? And it's interesting, if you survey people that listen to my podcast, besides friends and family who find me entertaining.
I think you're entertaining.
I drop a lot of sound bites on a lot of things because the initial purpose of my podcast was just to lay this stuff out so my adult children would listen to it. So they want to hear SpongeBob clips and things like that. And we put those in there for them so they listen to it. But anyway, getting back to this, if you survey most of my audience, it is a lot of engineers. It is a lot of doctors. It's a lot of people who ask the question, what else is there? I mean, if my podcast had a name to describe what we're doing there, is that question, what else is there? I've read Common Sense Investing. I've read all of these books about model portfolios that are 10, 12 years old. I know how those things work. I know how to be a successful do-it-yourself investor. Now, what else is there? And that's really what I'm trying to explore, not only for my audience, just for my own personal edification, because I do view personal finance as a technology that evolves and not something that is you're going to find the magic formula written on a Dead Sea Scroll somewhere.
Right. Right.
That over time, there are better financial funds, products, things. There's no fee trading now. There's more information out there. There are better ways of doing things now than there were 5 years ago, that there were 10 years ago, and certainly before that. And if we think about what we do now as hopefully the latest iPhone and what people were doing in 2010 as a BlackBerry, I think that really captures where do-it-yourself investing is now, or could be. Most people don't want to think that hard, which is fine, because the methodologies that were developed around 2010 or had come to full fruition are still good. They still work. They're still fine. But for us curious people, we do want to ask that question: what else is there?
Right. You don't want to fall into that foolish consistency.
No, that is also a major theme of my podcast in life. It's Emerson's admonition from the essay Self-Reliance, which is a foolish consistency is a hobgoblin of little minds, adored by little statesmen, philosophers, and divines, which is just the idea that just because you thought something before or did something before doesn't mean it's the best idea or decision today. It's interesting how often that idea appears in even personal finance.
Mm-hmm.
If you go back to a book like Your Money or Your Life, that book has a what she calls the parable of the ham, which is about a little girl is asking her mother why they cut the ends off the ham before they cook it. And the mother doesn't know, but she's been doing it her whole life. Asks her mother, says, I don't know, ask your grandmother. And they ask the great grandmother, and she says, well, yeah, I had to do that because it wouldn't fit in the pan.
Yeah, and you're right. There's so many things like that in investing.
So many things that are common talked about in personal finance are remnants or residues of ideas that may have been the best idea in the past, but are no longer the best idea because things have changed.
100%. Yeah. And things have certainly changed. First, like you mentioned, with portfolio charts and portfolio visualizer, investors have tools they never had before. On top of that, you have all of these wonderful ETFs where there's so many different ways to get great exposure to asset classes. It's been a sea change, I think, in the last 10 years.
That has really been a revolution. And there's two aspects to that revolution. One was the ETF revolution itself, and going from mutual funds to ETFs, and then expanding those into the basic factors and durations. So that is, if you know the history of Vanguard, it's very funny that the people that work with Jack Bogle and roll out the ETFs the first time, I listened to one of them is interviewed on Barry Ritholtz's podcast. And he says basically, Jack Bogle didn't want anything to do with ETFs. He hated them. And they almost had to do it in secret. But that was what the market was demanding. And by the market, I mean RIAs, people who manage money professionally, are looking for the best tools for their clients. And they started demanding ETFs, and not only ETFs, but ETFs that were not just, okay, here's a total stock market, but we want things that are factor-based. We want a small cap value one. We want things that are sector-based. We want one that's all energy. We want one that's all technology. And with bonds, you had then, Vanguard now, if you want treasury bonds at Vanguard, you have three funds. You have a short-term treasury, you have an intermediate-term treasury, and a long-term treasury. And you can combine those in the way that suits you, as opposed to having to take some total bond fund that is mixed in a certain way that you may or may not want.
Right.
But the evolution of those was kind of demanded by the marketplace of the registered investment advisors, people that run family offices and hedge funds, who I really look to as the best practices. If those people are using these products, there's a reason for it. And as a do-it-yourself investor, I want to know, why are they doing that? Can I do that? It would be good for me, or is it a bridge too far? And so that whole evolution, I think, was very important. And it's exemplified simply by looking at the products a place like Vanguard now puts out. And that the fact that they now recommend that their customers convert mutual funds into ETFs because they're more efficient.
Absolutely. Yeah.
The other more recent revolution has to do with the availability of alternative investments. And the SEC changed some rules back in 2018 around. that allowed particularly things that were based in commodities or futures trading or other alternatives to be presented in ETF forms. And so since then, in the past 5 years, there is kind of an explosion of different ETFs from, places like Simplify, and Wisdom Tree has gotten in there. Some of these things have leverage in them that is designed for a long-term holding, not the short-term trading things that have been around for a decade or more. But there are many, many of these alternatives coming out as we speak. I think Corey Hoffstein just released one this past year, which is like a combination between a treasury bond fund and a managed futures fund to do what he calls return stacking, which is another variation on the Holy Grail principle. all these methodologies are variations on this idea of maximum diversification, which is the Holy Grail principle.
Yeah, it's amazing. I am going to get some of the ETF providers on this podcast. So I'm going to talk to Jeremy Schwartz at Wisdom Tree. Hopefully we'll talk about NTSX and some of those funds. I'm going to get Alpha Architect on here. I'm really looking forward to talking to people who are kind of leading the charge of this whole revolution that's taking place, because it is amazing and it is a great tool for investors, I think.
Yeah, and I'm very fortunate with my podcast. I mean, I not only I'm aware of these things and listen to them and read them, but my listeners actually flag them and send them in. So it's, what do you think about this? So in a large respect, my podcast has turned into this kind of dive bar where these people hang out and talk about stuff. It's like, check this out. Did you see this? And then we talk about these various things. So some of my listeners are very interested in levered portfolios and building those out. And that has always been, that is another kind of separate Holy Grail, that obviously the original idea of risk parity was to take a very conservative portfolio and lever it up, which is not really useful for most do-it-yourself investors. But now we are getting to the point with these kinds of ETF products that may be more possible and viable. Particularly, you mentioned that Wisdom Tree product, NTSX, which is essentially a 60-40 portfolio combined of the S&P 500 and a treasury bond fund levered up 1.5 to 1. So it's like a 90-60 portfolio. But the expense ratio is only about 0.25. So it's a reasonable cost for somebody to use as the basis for a portfolio to construct something around. So somebody like Corey Hoffstein, who's doing return stacking, is going to take something like that and then put his, treasury managed futures thing or something else on top of that to gain some amount of leverage, but have a very diverse portfolio that ideally is still only going to have the same volatility characteristics as, say, a total stock market fund or something like that.
Gotcha. So before we get into leverage and more of the complex portfolios, I thought it might be helpful for the audience if we start off with some of the more basic risk parity portfolios. So I was wondering if you could talk a little bit about that Ray Dalio All Seasons portfolio, which you mentioned earlier in the podcast and talked about how you read that paper. So that seems like that was really, that and Harry Brown, I guess, were the first true cracks at this. So what do you think about that portfolio and what are kind of the limitations of it?
Yeah, where that portfolio actually comes from, just so we're clear on this was Tony Robbins' interview of Ray Dalio for his book, Money Master the Game.
Yeah.
And he asked Ray Dalio in that book, well, for some, basic do-it-yourself investor type person, what kind of thing would you recommend? And so at the time, he came up with basically this portfolio that is essentially 30% a total stock market fund, 55% in intermediate and long-term treasury bonds, and the remaining 15% divided into gold and commodities. So what Bridgewater was doing with that kind of portfolio originally was taking that and then adding leverage to it, because that is an extremely conservative portfolio with only 30% in stocks in it. It's marginally what somebody might want in the most conservative view of a retirement portfolio, but it's not really there. So to me, that is just a kind of reference to use. If you look at, there are two now ETFs that construct portfolios like this, but add the leverage. Those ETFs are RPAR and UPAR. And they have taken a portfolio that is organized a bit like that. It's more complex with more moving parts, but added leverage to it. So one of them is like 1.2 to 1, and one of them is 1.6 to 1. So that kind of portfolio, it can work for what you're doing, but it really is more of somebody that is managing some kind of a hedge fund with leverage, and they're doing some active management of it, which is why I think the idea of it is very useful, but as you probably don't want to take that off the shelf and use it by yourself. It probably is not going to be appropriate for either retirement accumulation or just about anything else. The idea, and this is what's interesting about risk parity, is it's developed far enough that it's in textbooks now. So if you go and pull out the CFA manual, there's a whole chapter just about risk parity. and we'll talk about this. And the idea of the other idea that is in there that is less useful for do-it-yourself investors was actually trying to balance out the volatility of each asset or risk characteristics. And they use volatility as a shorthand. This doesn't exactly match risk, but it's close. So the idea was to balance out those risk characteristics of the various assets that were in the portfolio. I think that's probably less important for most people coming to that, because it's not that, in terms of, say, a retirement portfolio, that and the safe withdrawal rate are two different things. The idea of trying to maximize the safe withdrawal rate and trying to actually balance out risk-wise the pieces of a portfolio are related, but they're two different things. In some respects, I wish I would have named my podcast something else, but Risk Parity Radio just kind of rolls off the tongue.
Yeah. It's a good name.
Holy Grail Principle Radio or Max Diversification Radio doesn't really roll off the tongue, and you're not even sure it's about investing. So I chose.
Might be about Indiana Jones and the Last Crusade or something.
Yeah, so I chose the most adjacent name for it, with the idea that yes, that is it's more of an example of this maximum diversification idea in a portfolio form.
Gotcha. So when you're talking about, so you mentioned like all seasons is kind of like the base portfolio, a basic portfolio without any leverage. So on your website,
I would call it a reference.
A reference
because I probably would not use that as a base for anything that I would hold myself.
Gotcha. So among those reference portfolios, like the permanent portfolio, all seasons, and Tyler's portfolio, the Golden Butterfly, which is 20% U.S. stocks, 20% U.S. small cap value, 20% cash, 20% long-term treasuries, and 20% gold. So among those reference portfolios, for someone who doesn't want to use leverage or get very fancy with it, what do you think is kind of the best of those?
Yeah, I think in terms of maximizing a safe withdrawal rate, there are a few principles that you can follow, or sort of guidelines. The first one would be that the portfolio probably needs to have between 40 and 70% of equities in it. And this has been verified by multiple sources. If you look at the Wade Files and the David Blanchetts and people who come from it from a retirement point of view, Michael Kitz's, those sorts of have gravitated towards that. And that was even apparent from Bill Bengen's original research.
Gotcha.
He thinks it's 55%. I think it's somewhere between 40 and 70. And that's what somebody like Wade File would say. Within that allocation, I think at least half of it needs to be value tilted. And so
want that cowbell.
Yes, that small cap value. So the simplest formulation is kind of what Tyler's done with half of his stock allocation is total stock market, half of it is small cap value. And so if you're looking for a simple solution, there you go.
Gotcha.
There are there's a lot of other options, obviously, within that. That doesn't talk about whether you want international stocks or not. I would not think of international stocks as a allocation by itself, but you need to apply factors to that. So if you want small cap emerging market, I think you need to be thinking about it in those kinds of terms. The other issue that is interesting that came up, I don't know if you've read, there's a paper by Alpha Architect that came out at the end of the last year, which was talking about whether the idea of small cap value is really more about value than small. And the analysis there is looking at an equally weighted portfolio kind of setup of value stocks, as opposed to the cap weighted things that people ordinarily run analysis with. And basically that what they found is that they think that having an equally weighted kind of portfolio out of value is probably a little bit better than just having straight small cap value. I have not dissected the paper in any way, shape, or form, but it's very interesting, and it makes sense to me because I think that there's a lot of other value related sectors that may be useful in a portfolio that you could put in there.
Yeah, that's a hot topic, whether or not size works. I think Cliff Asness, his view is that, I heard him on a podcast once say that it's not the size premium that matters, but factors tend to work better in smaller capitalizations. So I guess him and Alpha Architect can have a debate about that.
Yeah, there's an ongoing raging debate about that. I think you can get very close to good enough with those simple two funds that Tyler's got that probably meets the 80-20 rule in terms of this issue. I think the next principle that is for your bonds, you probably want to use Treasury bonds. And the reason you want to use Treasury bonds, U.S. Treasury bonds, is that they are the most diversified bonds from your stock holding, because that is your major driver still in these porportfolios is the stock holding. It's the most uncorrelated.
Like treasuries are the most uncorrelated with the stock market.
It's the most uncorrelated, and every time they move together, somebody says, "Oh, it's broken. They're correlated. Everything's changed. Dogs and cats living together." There are papers that actually go back to the 1950s that show that the correlation is volatile in and of itself, but typically when you get depressive or depression type episodes, recessions, that's when you see that negative correlation come to the fore. For that. The next principle, which is heavily violated by amateurs these days, is try to keep your short-term assets, and what I'm talking about is savings accounts, money markets, what are all those things that you are building CD ladders out of, or whatever you're doing. Those should probably be less than 10% of most people's portfolios, unless there's some particular reason not to do that. And that's because if you look at the analyses, the portfolios tend to degrade in terms of both their overall long-term returns, but also their long-term safe withdrawal rates when that pile of stuff gets too big. And where I see that happening most often these days is people are enamored with these ideas of bucket strategies and want to hold 15 different kinds of CDs and 10 different buckets. Which is both crowding out the main driver for your long-term portfolio of stuff, and then it's disguising the fact that your longer term stuff may not be very well diversified.
Do you think maybe it helps from a behavioral, even though it doesn't help a portfolio, do you think maybe it helps people's behavior?
Yeah, it may. I'm certain that's the psychology is correct, that kind of mental accounting is a good psychological tool. I think there's a confusion over whether it's a real strategy or a management technique. And I think that distinguish between things that are actual strategies of portfolio construction and things that are management techniques or labeling or mental accounting. And those things need to be separated. Another one is bond funds versus bond ladders. Those things perform the same over time. Ben Carlson wrote a nice article about this in November, and yet people think they are very different. They're only different from an observational point of view, and if you manage them differently.
Right.
But if you are holding them over a long enough period of time, you're going to end up with pretty much similar results. So that was my third. So we got three. We got the stocks, 40 to 70% with
a pivot to value,
with at least half in pivoted to value. We've got used treasury bonds for your bond holdings, and I'm talking about your intermediate and long terms. Keep your short-term assets below about 10%, unless you have some other good reason for going over that. And then the last one is alternative investments. And I think the amount of alternatives, gold is the classic one. Managed futures are also available now in fund forms. DBMF is a good example of a kind of index version of that. I think that needs to occupy between 10 and 25% of your portfolio, and these portfolios are designed to yield the best projected safe withdrawal rates. That's what they're designed for. So one of the best tests of that, if you are familiar with Early Retirement Now and Karsten Jeska's site, he has a calculator there that goes back to 100 years. It's got all the Fama French stuff back to 1926.
Wow, okay.
And then some other data that goes back to 1871. And so you can run a portfolio like I've described in there. It is in a spreadsheet form, so it's not that user-friendly. You have to really go through all the lines and make sure you put in the right parameters in the right box.
If you want a century of data, you have to do some work, I guess.
Yeah, well, in contrast with what Tyler's done, which is keep all that behind it. So you put in your things and it pops you out nice charts.
Yeah.
This has some nice charts, but most of it is data-based. But anyway, you can get a portfolio that shows a historical safe withdrawal rate of over 5% with those principles.
With those basic principles.
With those basic principles.
So among the alternative assets, so you mentioned gold is kind of the king. That's the most classic one. I prefer in my own allocation gold simply because it's very low fee. It's easy to get access to. It seems to have the most uncorrelated relationship over time. So that's my preference. Yep. You mentioned managed futures. So I'm a little skeptical of that. Maybe you could convert me a little bit, where I've always thought that kind of those managed future strategies over the long run don't really deliver a return, where you're making a lot of money kind of when there's a big volatile market. And then, but over the long run, it doesn't really do as well. So what would be the case for managed futures and like through that? Like, am I wrong in my understanding of that, or?
A little bit.
Okay. Okay.
The problem with them is not that they haven't made money over time. The main problem with them, at least for the average investor, is the vehicles that you invested through were too expensive.
Gotcha. Okay.
They were charging like up to 3%.
Oh, geez.
Yeah, and so what you're looking for is a return of 6 or 7%, or between 5 and 7% real. So it's going to be less than the stock market. It's going to be it's going to be somewhere in between what you would expect a long-term bond holding, treasury bond holding, and a long-term stock market holding to have. And the problem and why this area, I don't feel it has been investable for most of its existence, unless you were actually running some kind of institutional pension fund or something, picking your own managers and going through all of that, is that there were no like index fund type products.
Right.
And now there are.
Yeah.
But again, I think that's an optional thing. I think you can be fine just with using a little bit of gold in your portfolio.
Right.
And by the way, the optimal amount of gold seems to be between 10 and 15% in most portfolios. And that is also based on actually research that Karsten Jeske did. If you look at safe withdrawal rate series number 34, he ran some portfolios with gold in them going back to 1926 and basically concluded that somewhere in between 10 and 15% is probably likely the optimal amount of gold in a portfolio to hold if you're going to hold it. That's the history of it.
Makes sense.
It's probably more valuable now than it was prior to 1970 because the dollar isn't pegged to it anymore.
Mm-hmm.
And so the one of the kind of paradoxes about a diversified portfolio is you actually do want some volatility in your assets because you want them to go up and down at different times so you can rebalance them. That's how you get a higher safe withdrawal rate in most instances. It's just the function of rebalancing things over time as they're all moving up and down together.
It is an amazing, that is an amazing thing. And it's so counterintuitive. Like and that's that Shannon's demon thing that Tyler has written about, where you can have where it showed that basically you can have 0% long run return assets. And then if you're rebalancing them, that generates a return. And then you see that in a lot of these sample portfolios where often if you just average together what the assets on their own return, the portfolio always delivers a little bit more, which always blows my mind every time I see it.
And that is why it is so difficult to, and why you should not as a process say, oh, this asset looks good. Let me just stick it in my portfolio, because they all have to work together. And the overall performance of the portfolio almost comes out like an emergent property that you cannot, as you say, you cannot just look at some average of performances of the individual assets and conclude what a portfolio of those things actually will do. And that was one of the most amazing and interesting things to me. It's like fractal magic with Benoit Mandelbrot.
It's like alchemy or something. Like, how is this possible?
Michael Mauboussin writes a lot about this kind of stuff.
Yeah.
But yeah, that was part of the revolution, is by having tools that can actually put these things together and see what they would have been like, you can come up with a lot better ideas of what you want to hold than what we were doing before that, which was, well, maybe some gold is a good idea in this portfolio. How much? Like, I don't know. And so the solutions were the kind of Harry Brown solutions. It's just like, well, let's just divide it 1/n, and which when you think about it, probably doesn't make much sense because they all have different performance characteristics and different risk profiles, which is where the risk parity idea comes in. That if you have something, say you want to put Bitcoin in your portfolio, I mean, that has a risk profile that's like 10 times more volatile than probably anything else in the portfolio.
Yeah.
And so unless you limit that to a very small percentage, it's going to overwhelm the performance of the portfolio, that it'll all be about how well Bitcoin did that year.
Right.
If your portfolio is 20% Bitcoin, it's going up, up or down 50% in a year. All right, well, that's 10%, that's 10 points of percentage that's applied to the entire portfolio. So so something like that, if you put a volatile asset in your portfolio with in a too large of a proportion, its performance will just dominate and drown out everything else.
Yeah, 100, and that's kind of what Ray Dalio was talking about originally with this concept where stocks were just dominating the return of every portfolio, and here's some ways to mitigate that.
Yeah, and that principle is also, I think, why portfolios with a moderate amount of stocks in them tend to do better in terms of being able to withdraw from them, draw down on them over time. That a portfolio that would be 100% stocks only has a safe withdrawal rate of about 3.3, 3.4, because of its volatility.
So something I want to ask you about safe withdrawal rates. So there is a lot of, I think, misconceptions about safe withdrawal rates in the financial world. So people tend to think, 4% applies to everything, 60-40, 100%
That's the
stocks.
first mistake.
You see it get thrown around all the time. So high level, like what do people not understand about safe withdrawal rates?
Well, the first thing is what you just mentioned is that every portfolio will have a different projected safe withdrawal rate based on its components and then also how it's being managed in terms of rebalancing. And so that is, one principle. There are basically three principles we're talking about here in terms of portfolio construction for a retirement portfolio. The first one is this asset allocation. If you're trying to determine, well, what can I withdraw from this portfolio? The first idea is, well, what's the asset allocation? And if I put it through just these Bengen assumptions, what would the historical safe withdrawal rate of that be? That's the first thing. The second thing is well, how much are you withdrawing in terms of a mechanism? And then the third one is, how are you adjusting that withdrawal? And this is something that people are just now beginning to understand and talk about, because the original assumption of the Bengen portfolio is a conservative assumption that the holder will automatically increase their spending every year by the rate of inflation. In truth, that was done for convenience because that's the data he had. And nobody does that. The more reasonable assumption we now have is what we learned from David Blanchett's research, which is that a typical retiree will draw what they call a retirement spending smile. If you're looking for a way to just incorporate something like that into some kind of analysis, it basically works out to an average of CPI minus 1%. So an average retiree should be thinking about my likely expense track is going to be, if I'm just an average person, is going to be 1% less than what the CPI is, which if you put that assumption in there, you're automatically bumping up your safe withdrawal rate by about 0.6. The other things that are now being talked about is Guyton Klinger and all of the different methods of withdrawing, and they all modify that safe withdrawal rate. Some very significantly. The Morningstar did a nice review in November, December of last year, where they took about 5 different of these variable withdrawal type strategies and applied it to a portfolio to see how that affected the safe withdrawal rate calculation. And it tended to raise it in most circumstances from, 0.5 to up to like over 1, if you're talking about some of these strategies where you are modifying your withdrawals significantly by reference to the performance in the market.
Gotcha.
And those things divide into 2 ideas. One being you're making your variances based on your own personal expenses and experiences. It's like, well, I just won't go to Tahiti this year. I'll spend less. And the other one, and then there's the other one, which is, well, I'm going to do this on some market-based metric. What you find from that is you get more bang for your buck on the market-based things, but then you are basically committing to not spending money based on what the market is doing, or spending more money based on what the market is doing, as opposed to just making your own adjustments in your own lifestyle, which is probably more palatable to more people.
Gotcha. Yeah.
That I, don't want to tell Junior I can't pay for his college this year because the market.
Sorry, pal.
You better fill out that FAFSA. So this is a moving target that it's not just 4%. It doesn't apply to all portfolios. And it depends on how you are managing that thing will also change the metrics there.
Gotcha.
And some of the things that we talked about before, for instance, making sure half of your portfolio is value tilted, that also has a tendency to raise the safe withdrawal rate. When Bill Bengen has done his more, and I wish he would publish this, although I understand he's getting up there in age, but he talks about it a lot, but he hasn't published it. But basically he says, if I would have used a better portfolio that was like value tilted and had some other asset classes in it, I can get a 4.8% safe withdrawal rate based on my original data.
Yeah, And I think that's super inspiring that there are portfolios that can make a 5% safe withdrawal rate. I think that dramatically kind of changes how much you need to save, how long your working career needs to be. It definitely, I think frees you up for what's possible.
It's another lever to pull that you have a portfolio construction lever you can pull to raise your projected safe withdrawal rate, how much you can spend. And then you have this withdrawal mechanism lever you can pull to also modify that and make it better in your circumstance. What is one of the funniest or more interesting paradoxes to me is that most kind of gurus in the personal finance space, whatever you want to call them, people you know about, they're chronic underspenders. And if you look at what they actually hold and what they actually spend, they're typically spending 2% or less, which
so they're going to die with a lot of money.
They're going to die with a lot of money. And also what they're doing is actually not geared towards the idea of, my idea is, well, I want to be able to spend more. Even if I don't spend more, I want to be able to spend more of my money in retirement before I die.
Yeah.
Because you can always solve this problem by not spending money. You can always solve the retirement problem by not spending money. And if your withdrawal rate is less than 3%, you can hold just about anything.
Gotcha.
You get 30% stocks in there. You want to load it up with all kinds of annuities, bond ladders, whatever. It'll work.
Yeah.
Because you're not spending your money.
I think that's Warren Buffett's approach. 100% stocks. I mean, I'm a billionaire. Who cares?
For him, that's, I mean,
yeah.
Of course, he says, hold 90% in the S&P 500 and 10% in
short-term treasuries.
Short-term treasuries. Yeah, that if you're spending less than 3%, that's always going to work. Yeah. You can hold 100% stocks. You can hold 100% stocks. You can hold 30% stocks, and spend less than 3%. You're going to be fine either way. So a lot of times what people say is their strategy for retirement is not their actual strategy. Their actual strategy is don't spend money. Which kind of makes up for all the weird stuff they're doing that is not actually, based on any analysis, is based on psychology, comfort, familiarity, something they like.
But I mean, that's probably how they got so much money to begin with, is because they're so averse to spending money. So I guess it's a tough balance is to kind of turn your brain in a different direction.
Yeah, no, it was interesting. I think both Bill Bernstein and Alan Roth in the past year have decided that now is the time to create gigantic 30-year bond ladders. and Bill Bernstein, 74, he wrote an article saying, "Oh, well, this will take me out to 104. I'll be good." It's like, Bill, I think you can you can handle it.
So,
but again, that's just, you can do anything you want if you're not spending your money.
So we've talked about safe withdrawal rates and using these portfolios for retirees. What are some other use cases for one of these risk parity style portfolios?
You can also use them, or really any kind of retirement portfolio, for intermediate accumulation. And what I'm talking about is something like you are saving for a down payment on a house, or some expense that it's going to be 3-5 years. You're not sure exactly when it's going to be, and so you're just using that to build up some assets, because the prior solutions were, well, you need to put it all in cash or a savings account, or you need to put it all in the market. I think no, there's an intermediate thing you can do here, and one of the ideas is to use one of these kind of portfolios. And so this is something that my children do, my adult children. They're in their 20s. So they save for houses and other expenses in a risk parity style portfolio. So they have their retirement stuff, and I just told them, put it all in S&P 500 and a couple other funds you can find there. They have some cowbell, small cap value, put them in there, and just leave that alone. And then, have some money for emergencies, expenses that is just sitting in your savings and checking. But then you have this intermediate fund that they build. And so our first one is on his second house. The other thing that I gave him was Scott Trench's Set for Life book, which is about house hacking mostly and saving. And so he's used this kind of portfolio to save for the down payment for the first house and now for the second house, and continues basically to throw extra money into it. And so it just builds, and it's just there for these kind of big expenses that you're looking for to save for. The reason why this kind of portfolio can work well for this is probably what Tyler has mentioned with like the golden butterfly portfolio, is these portfolios tend to have a maximum time of drawdown of less than 5 years or less than 3 years in most circumstances. Right. They don't stay down very long. Whereas if you are putting your money in a traditional like 60-40 portfolio or something that's just a stock bond and a bond fund, a stock fund and a bond fund, that kind of portfolio can have a drawdown of up to 13 years historically, whether it's the 1970s and the 2000s.
Which so I don't think a lot of people understand that. So like I think most people think of, it'll be back in 6 months or a year if they've been investing for the last decade. But that's something most people haven't even contemplated.
They're always talking about this average drawdown. And the analogy you need to think about is, okay, you got to wade across this river. The sign says it's an average of 4 feet deep. You're going to wade across it without any... You can't swim and you don't have any other.
Right.
You're not concerned about the average. You're concerned about the maximum problem and how often that occurs, because those are the kind of the two features of portfolios that play into the safe withdrawal rate: is how deep is the drawdown and how long is the drawdown. Mm-hmm. And so that if you have something with less than a 5-year drawdown that you are continually putting money in anyway, because you're basically dollar cost averaging into it, that mechanism or practice also tends to reduce with the drawdown of a portfolio because you're investing in the trough. So, but that is what our adult children use this kind of portfolio for right now, to build these kind of intermediate funds that they can then use for houses, cars, boats named YOLO, things like that.
Well, that's a great use for it. What do you think about people like me who use these portfolios for accumulation? So I just do it for accumulation because I don't want to lose money for 13 years. So what do you think about using it in those situations?
I think it's fine. It'll take a little longer than it might for another idea. But if you're not in a hurry, you should be fine. I mean, if you want to maximize accumulation and you don't care about volatility, that's the thing you're saying. You're saying you do care about volatility.
Yeah, I care about it. It freaks me out when I see the market crash.
Because that is also a principle that needs to be adhered to, which is whatever you're holding, you need to hold on to it and keep doing it. Because the worst thing you can actually do is start jumping ship, fund chasing, getting in and out of stuff. That's why people tend to underperform, not because there's something wrong with the portfolio that they've gotten. It's because they can't hold it for whatever reason. And so you can certainly, and I think Tyler mentioned it, he just would prefer to hold a golden butterfly as an accumulation
forever. Yeah.
Which is, it'll work. It will probably take a little longer than it would have had he done like half total stock market and half small cap value in a Merriman accumulation 2-fund portfolio. But the trade-off is, if you were to go with that 100% stock portfolio and freak out when it's down 50%, which it will be at some point,
right,
and then bail on it, you screwed yourself over, and you should have just gone with the more diversified portfolio and rode that one. Because in that circumstance, all of a sudden, the tortoise, the diversified portfolio, is going to march ahead of the hare. The person that bails when it's down misses the rebound. It's deadly.
Yeah, one of the most depressing graphs I've seen is the average investor return versus multiple asset classes. And basically the average investor underperforms like the CPI, like because of that, because they're all risk on when the market's hot and then they bail at the lows. And what that does is it just produces like a 1% return over the long run.
Yeah, that's very true. That's where this bogey or comparison metric comes from. And I think it's a Vanguard study that was based on trying to improve the relative value of financial advice. You basically compare it to people that make a lot of mistakes.
Yeah.
And those two common mistakes are wait till something's high, buy it high, and hope it goes higher. And then sell in a panic. And it's interesting, a lot of the material that is presented to investors encourages bad behavior.
Mm-hmm.
And what I'm getting at specifically there is you go to your 401k and you open it up and they give you these funds, they list all these funds, and then they go, here's the 1 year, 3 year, 5 year, and 10-year returns for this fund. And too many people use that as a basis for choosing what they invest in.
Mm-hmm.
And they're essentially buying high and hoping it goes higher. They don't realize that short of a time frame is not a long enough time frame to make a judgment as to whether you should be holding something or not. It's that, and so the very presentation of things like that encourages fund chasing. 10 years is just not long enough. Really what you want to see if you're going to do any analysis is you want to see the asset go through all of its different economic cycles. What did this do in 2008? What did this do in the 1970s? That's how you go about looking at these things.
And I don't think people understand that. I think most people think, 10 years, that's a long time. But in investing, it's nothing.
No, it's not long enough. I was listening to a nice interview of Oswald the Motorin.
Oh, he's great.
This is on the long view if you want to look up the podcast. And he was talking about valuation metrics. Mm-hmm. and the use of valuation metrics for predicting future stock returns or outcomes. And he's determined that the best one he can find is the equity risk premium, basically the difference between what equities are performing and treasury bonds are performing, mm-hmm. which he tracks religiously, like daily. But he says that is the best one I could find, but I would never use it for trying to predict or make asset allocations because it's only about 17% correlated with actual outcomes.
Jeez. Okay. So it's the best one and it's only 17%.
This one's better than all your CAPE ratio, all your PE ratios, all of those valuations. This is the best one according to the master guru Yoda of valuation. Mm-hmm. So this is one area where I will take his word for it without really needing to look too far under the hood. But he also said that in order to draw any conclusions about using one of these metrics for predictive purposes, you would need more like 150 years of data.
Jeez.
Not 10, not 20, not 30, 150 years of data.
Yeah, a couple lifetimes.
So, that is something that, everybody's looking for a crystal ball. There's a lot of valuation crystal balls floating around out there now. And what he's basically saying is stop looking.
Could use Sonia's. Yeah, I've always been amazed by that. Like when I first was introduced to the Shiller PE, I thought that was the answer to everything. And I said, oh, easy. This is easy. When the Shiller PE gets too high, you sell. When the Shiller PE gets low, you buy. And in practice, it doesn't really work.
Yeah, a lot of it was interesting. And this also goes, I always want to look at the history of an idea. Mm-hmm. And in this case, the history of that idea is particularly interesting because where this all came out of, right after the financial crisis in 2008, it was then that these papers were published about using the Shiller PE to predict future performance of the market. And so if you look at what people were writing about in, say, 2010 to 2013, 14, there's a funny article that Morningstar published in 2011 where they interviewed Jack Bogle and a whole bunch of other people, who's Jeremy Grantham, and they were all saying, it's like, yeah, based on this PE ratio, I think the next decade's not going to be very good returns for the stock. Just not going to be very good.
Dead wrong.
Probably 4 or 5%.
Right.
And you can imagine if you would have made a decision based on that, how bad that would have been. That the other, there's a paper, and I recently cited this in my podcast from 2013. I think it's written by David Blanchett, Wade Pfau, and Michael Finke, all very highly regarded people in retirement services. And they were saying that in 2013, based on these kind of metrics, these valuation metrics, that they thought that the chances of a portfolio having a safe withdrawal rate in the next period of 4% were only about 50-50.
Jeez, okay.
Yeah, that didn't work out so well either.
No.
We don't talk about that paper anymore. It's still there, though. That's the great thing about the internet. So Michael Kitces actually looked at this, and I always go back to him when it's like, well, who's actually looked at this and determined, what there is to it? And he basically said, it's like, it may tell you, a CAPE ratio may tell you something about what the returns will be in 10 or 15 years. It's not really going to tell you that much. And if you try to use it over a longer projection, it's wrong because of reversion to the mean. That if the market has if the next 10 years are particularly bad, usually the 10 years after that or 15 years after that are going to be better, and vice versa. And the problem is you don't know which one's coming first.
Yeah.
And it was also that what people also recognized at that point in time was this mean that they were trying to revert to, in fact, is not a stable mean.
No way.
It's not stable. And since it's not stable, which makes sense because markets are not normally distributed.
Right.
They're distributed on power laws and fractals. And so since that mean is moving all the time and you don't know which direction it's going and why, there's no real way of doing it, of saying that this is too high.
Yeah.
Because you don't know what you're comparing it to. And so the most recent work of people that are trying to do things with this are they keep trying to figure out, well, how does the mean move? Should I use a different mean? The other problem I see with it is an interesting thing that nobody talks about, which is, okay, that it would be nice for a portfolio if we're talking about valuation, PE ratios or something like that. That's a portfolio that's the entire market, or an S&P 500 that's cap weighted. What if your portfolio is not that? What if it already has a bunch of value stocks in it, and so it has naturally a lower PE to begin with?
Yeah, small cap value can do its own thing.
What's the mean of your portfolio?
Right.
And so, like the safe withdrawal rate, I think you would need to, in order, if you were going to do this in a rigorous way, you would actually need to calculate a different CAPE ratio for every portfolio based on what its historicals are, based on what it's made out of. Because the average PE ratios of different, not only different factors, when you get to the sectors, it's like, all right, well, the average PE ratio of this, the semiconductor tech thing is, 84, and the average one of this timber company is 7.
Right. Which is one of the misleading things about international valuations. Like if you have some international index that's all in one like kind of garbage sector, well, of course it's going to have a lower Shiller P than the US.
That is another deep problem that people don't appreciate. It's one of the things that I learned as a lawyer, because I spent most of my career working with financial and technical experts on valuing things like a steel mill in Romania or a gold mine in Uzbekistan.
Oh, wow, that's cool.
And so for every country, there is a different country risk factor that you would apply to it based on things like how good are its laws, how good are its court systems, how good are its capital markets, all these things that are idiosyncratic to a particular country. And you would use that in terms of valuation to modify the discount factor you're applying to a discounted cash flow analysis. So what that tells me, and if you go look up World Bank statistics about various countries, they put different risk profiles, percentages on different countries based on how well their markets and legal area functions.
Yeah.
And so for international investing, you cannot, first of all, it's not methodologically correct to compare the PE ratio of one country to what's going on in another country.
Yeah.
They should be different.
Yeah.
The averages should be different. Everything should be different because it's a different place and they do things differently there. And so you can't mix and match those things. You can't compare them. You can't say because the valuation metrics for international stocks have been less than US, that is a basis for saying that one of them is going to revert to the other one. They're not going to revert to each other because they're composed of different things. And where you see that most dramatically is when you start looking at what sectors do these particular markets represent. And so for the US, there is a heavy tech sector, big tech, all the biggest companies in the country now, the Amazons, the Microsofts, the Googles, the Facebooks. Those don't exist in other countries. So that skews the market towards that sector.
Yeah.
Now, if you go to Canada, what is on their stock market?
Banks, natural resources.
Banks and natural resources.
Yeah.
Same thing in Australia. You go to many other places and their market is fundamentally different than another country's markets because the kinds of companies and sectors represented on their exchange are different. So you would need to go, and you can find things listed by sector and subsector that have all of the average PEs for all these things. But in order to do this in a rigorous manner, you would need to break down each country by its sectors, figure out what should be an average for this group of sectors in this particular market, and then decide based on its own reference whether it's high or low. That comparing that market with that other sector to this other market with different components in it is not methodologically sound.
Yeah, that makes sense.
There's just another reason that cannot work in any useful way. But it is commonly used. That watch any channel about talking about investing in different countries, or it's like, well, they've been doing badly and their valuation metrics are lower than the United States, so they're going to catch up.
Yeah, not necessarily.
Where's their Google?
Yeah, coal companies are valued differently than Google.
Yes, coal companies are valued differently, and it's striking particularly in developing countries. And I think this is one of the areas that is difficult for people to understand, that in a lot of emerging markets, the kinds of things you would want to invest in are not publicly traded. They're private companies. Yeah, the consumer oriented things that we can invest in the United States are not investable in that other country. And what's probably on their stock market are some very large financial institutions that are moribund and connected with the government, along with some other industries that are also wound up with the government.
Yeah, something I was hearing a few years ago was that Russian stocks are cheap, and it turned out they were cheap for a reason.
That is a prime example of a country risk.
Yeah,
that if you have undemocratic countries where strange things may happen, wars may break out, other issues may arise, that there is a reason why those valuations are really low in those countries.
100%.
And it's funny because if you talk to economists who study this and read the World Bank stuff, it's like, oh yeah, that makes sense. But then when you listen to people talking about investing in international funds, it's like they're saying things that no, that's not how it works. It's not
Doesn't hold up. Not how any of this works. Yeah. And I mean, I think the other limitation of it is there's no announcement of when the low is, when the high is. Like one of the things I thought about was if you like ended the CAPE ratio in 1995, you would say, oh, well, the high was in 1969 around 20, and it's at 20 now, and the low is 8. So easy. I'll sell in 1995 and I'll get back in an 8. Well, it went to 44. It never got back down to 8, and you would have like been out of the market for 20 years.
You would have missed everything.
Yeah.
And that's comes back to what the Modern was saying. It's like don't use those for that's not a good process for your investing.
100%. So, okay, so let's talk a little bit about leverage. So you have sample portfolios that use a lot of leverage, which are experiments, I understand. And then there's like something like
experiments.
Yeah, heinous experiments where crazy things are happening. And then there's like a portfolio like the Risk Parity Ultimate, where you have some leverage in there. So how do you think about leverage? What do you think is the right way to go about it for an investor?
Yeah, I don't know what the answer to this is. This is an evolving area in my mind. That what I've seen evolve, well, first we know that, putting too much leverage in anything makes it explode. And that's sort of been from time immemorial. Go back to long-term capital management.
It's a graveyard.
The most sophisticated investors. But there's also good academic research, and Ben Felix and the Rational Reminder people have talked about this before, that is one of the ways to make a portfolio perform better, to get more out of a portfolio. There are basically two ways. Either you need to be a good stock picker and pick the right sectors at the right times, or you need to add leverage to it. And traditionally, hedge funds did add leverage to really conservative risk parity style portfolios and use that as a method for investing. So what has come out for do-it-yourself investors is that was difficult to do in the past, because either you had to know how to trade options and futures pretty well, or you had to take margin, which was a margin call, often very expensive and very difficult to manage. And most brokerages discourage it based on what they charge. Schwab or somewhere like that. You need to go to Interactive Brokers or somewhere like that that's intended for that purpose. So, but then we have these leveraged funds now, which were originally designed as trading vehicles, and the first ones came out UPRO back in like 2009, 2010, that era. And so those are short-term trading things. But then people started using them for longer term holdings. There is a nice site called Optimized Portfolios. I don't know if you know that guy or that site, but he's all about analyzing these and coming up with leveraged versions of all of your traditional kind of portfolios. It was still that they weren't really designed for that purpose. And now we're coming around to leveraged funds that are designed for long-term holdings, like NTSX, like we mentioned before. But then we also have people who are working in this area, professionals, like at Simplify or Corey Hofstein, or people at Resolve Asset Management and the RPAR and UPAR funds. So then you get to two other questions. Well, how much is the right amount? And people are only beginning to grapple with that. The answer seems to be somewhere between 1.5 and 2, based on what I've read in the past couple of years. And that's where people tend to gravitate towards. And there is also an interesting paper called Buffett's Alpha, which analyzes Berkshire Hathaway based on the leverage that it incorporates due to the float of the insurance companies inside of it.
And he's basically applying that to low beta, high quality, large cap value.
And so, and that ratio is 1.7 to 1. And so these all seem to be converging around that area, which also happens to be the golden ratio, by the way. 1.61 to 1. But how much and how to construct these things is still kind of a mystery. People are coming up with ideas and playing with them. And I have a lot of listeners who are very interested in this topic and are doing all kinds of interesting things with it. For me, it literally is, that is an experiment. That is something that is developing that I'm interested in, but I can't say that I know what the right amount of leverage is and then what it should be applied to or not applied to.
Yeah.
That's one of the things I don't have an answer for.
For the audience, when he gets one of these questions, he'll typically play Homer Simpson saying, "You have a gambling problem," when we're talking about these leveraged funds. I always get a kick out of that.
Marge, you have a gambling problem. I have a listener named Alexi who is a doctor in his actual life.
The dude, right?
The dude. We refer to as the dude because he said he liked The Big Lebowski, so I started calling him the dude. But he is always coming up with different variations of leverage portfolios and saying, check this out and check this out. And I really, it makes me happy that people are taking, the work that I'm doing and doing something else with it, because, I don't pretend to have all the answers. And I like to say I don't have any answers. I just go try to find them. and collect them and present them, and because I think that other people are likely to come up with better ideas than that I'm likely to, and it's the kind of open source do-it-yourself investing. It's kind of the way I would describe what we're trying to accomplish there, because people will come up with other things. You had mentioned that Risk Parity Ultimate portfolio. That is, I just wanted to have. I have 7 sample portfolios now. I really don't want to manage more of them, and just wanted to have, but I did want to have something that basically had some little piece of just about everything you could think of in it that somebody might use. And so it's not really optimized in any way, and there's no way of back testing a lot of that stuff, because we're got things in there like a commodities fund and a volatility fund and some other things like that. And so it really is kind of a kitchen sink there. But those are things that I'm constantly trying to look at and evaluate. The missing holy grail piece to me has always been trying to come up with a good investment in volatility.
And Chris Cole, I think he's talked about that in the Dragon portfolio.
But I think his fund blew up.
Oh, geez. Okay. I guess that's not such a great idea.
If you looked at Dragon portfolio stuff there's a lot of it's no longer there anymore. And the last I heard, he had joined forces with the Mutiny people with their cockroach portfolio.
So I guess,
I don't know what happened. My speculation is that last year was really hard for people who were trying to invest in volatility, because it didn't pan out that you would expect there to be much more in the way of volatility spikes with what happened with markets last year and their bad performance. But those volatility spikes really did not appear except in bond markets.
Yeah.
And so that strategy really suffered, and I still don't know what the answer to that is. We certainly do not have good funds for investing in volatility. I can say that.
Yeah, markets tend to have sharp drawdowns, and then last year was kind of like an orderly drawdown, and it also happened to have an orderly drawdown at the same time that bonds went down. So I could see how a strategy trying to combine volatility with a stock and bond correlation would probably not work. It was just the year it didn't work, and it was enough to blow it up, I guess. Yeah.
So no, something happened there. I don't know what happened, but it's sort of like, I know that a lot of my links to what he had done over there, because I talked about this Dragon portfolio back in early 2021 podcast, and a lot of that stuff is not there anymore. But it was an interesting idea. I mean, he had gone back 100 years and came up with this portfolio that was basically, it was 20% stocks, 20% bonds, and then he had
Something like that, yeah.
Gold managed futures and volatility investments. And again, when I looked at it, I said, these can't be the right proportions.
Yes, it wasn't.
They're too close together because these things are much different in terms of the way they behave.
This is why I'll keep it basic. I'm content with my gold fund and my bond funds and my stuff.
Yeah. I think, and I think most people are.
Yeah.
I know that a lot of the people that listen to my podcast have gravitated towards golden butterfly or golden ratio kind of things, but to their credit, they've modified them to suit what they're doing and what they've already have or what they already like. These are not put out as the be all and end all of anything. They are put out as, basic ideas to build something around. And I do know a couple people that invest in things that look like that Risk Parity Ultimate, but generally they've also made different modifications, or to the extent they're investing in volatility, they've got it on a different kind of rebalancing schedule. So they're basically, whenever it spikes, they chop it off.
Gotcha.
And so I think that probably makes sense too, to do it that way. But it was interesting the way, and just so your listeners understand, I actually just started these portfolios. They're at Fidelity. We look at them every week and see what they did and track them over time, because I think it's much different living through something and watching it go up and down, rather than looking at some back test where 5 years are compressed into 2 inches on a chart.
Yeah. You're like, oh, that looks easy. So no big deal. 5 years, that's nothing.
But since,
real life, it's different.
Since 2022 is like, the worst year in 40 years for most diversified portfolios, it really is an interesting, to me, it's an interesting test. For other people, they would say, oh, this looks terrible. It's like, of course it looks terrible. 2022 is a terrible year. And I didn't have the presence of mind to take all the money and put it in managed futures funds.
So that's interesting. So there's a question I get on these a lot, where the criticism I always get when I talk about this is, well, you're just looking at the data through a 40-year bond market, and the correlations are all going to fall apart between these assets. And then after 2022, they typically say, aha, you see, it didn't work. So what would you say to those people?
We do incorporate the 1970s into this analysis, which takes care of that. And then when I gave you that 100-year analysis, that incorporates the Great Depression, World War II, and a lot of other things. Also, the other research, and there's an interesting paper that talks about, in particular, the correlation between treasury bonds and the volatility of the stock market. So it's basically, and they update it all the time. And it goes back to the 1950s. It's published by some researchers in North Carolina at the university. And so all of those things those criticisms are superficial. And they don't pan out. And the main issue I have with them is like, all right, what are you proposing as the alternative?
Yes. And usually it's some active strategy where they're trying to predict when these things are going to happen.
Yeah. That we have to actually be comparing proposal A, portfolio or strategy A, with a different strategy. Because you can always go look at a strategy in isolation and just nitpick it. Oh, it didn't work here. Oh, it didn't work there. Oh, right. But that doesn't mean anything. What also is another kind of meaningless phrase that people throw around and they don't really appreciate what it means and what it doesn't mean is, well, past performance is not indicative of future results. As if that means that your strategy is going to perform worse in the future. No, all that means is you don't know. Yeah, my answer to that is like, yeah, this could be even better than what you were, an even better alternative in the future. It doesn't tell you anything.
Yeah.
What that is really getting at is this data issue that we talked about with Oswald the motor and he said we need 150 years of data, because statistically, if you only have a short period of data, you can't make any conclusions out of it, and you need more data. And in my mind, what the important data is the data that comes out of bad environments or particular environments.
Yeah.
So a year like 2022 basically has a base rate occurrence of 2 or 3% of the time. You'll have a year like that.
Yeah.
Just historically. But the fact that a portfolio being down 15 to 20% in that kind of a year, if that's the worst, that's not very bad.
Yeah. It's not a big deal. Yeah. And I mean,
particularly if it, recovered 5% in January.
Yeah.
So those are a lot of kind of qualitative criticisms that don't usually mean much when you look at the quantitative comparisons.
Yeah. And I think if you just apply common sense to it, like, are stocks, treasuries, and gold going to behave differently from each other? I mean, I think the answer, if you just apply some common sense, is unequivocally, yes, they're going to behave differently. So this should work.
You would not expect them to behave similarly
right.
for any particular reason.
It can happen in 1 year, but to happen, I'd be amazed if it ever happened over 5 or 10 years,
Yeah. And when you say something is uncorrelated, it means it will move in the same direction as something else about half the time.
That's a good point. It's not perfectly inversely correlated. It's uncorrelated. Yeah.
That nothing is perfectly inversely correlated all the time. What you have is a probability, but that is also related to economic conditions. And I suppose that's one thing that we didn't talk about that I probably should mention, because the fundamental idea behind risk parity and diversification is this idea, and it's what you're getting at as to, well, why do these assets perform this way at this particular time? And the idea that Dalio has come up with, and then other people have used, and everybody says is my idea, and they argue about whose idea it is simply that if you look at a matrix of increasing growth or decreasing growth on one axis and increasing inflation or decreasing inflation on the other axis, you can basically plot which asset classes do well in each of those quadrants of this thing that I've constructed. And so the basic idea is, well, let's have something in each of these quadrants, because we know we're going to experience all of these economic environments. We just don't know which one we're going to experience, how severe it's going to be. But the idea of diversification and why you expect these things to perform differently is because they live in economic environments that are changing all the time, the weather, if you will. And so you want to pick things that from prior experience tend to do well or badly and match them together so you have something in every quadrant. And that's the sort of qualitative explanation for why these things work out the way they do in terms of, the quantitative would be the correlation numbers you come up with, but those are going to change depending on the time frame you're talking about. But that I think gets lost, that when people say, oh, these things are correlated now and everything's changed, there's a new paradigm and stocks and bonds are going to be 100% correlated from now on. Why do you say that? What evidence do you have for that? That's not consistent with past. What's consistent with past data and economic environments is sometimes they're correlated and sometimes they're not.
Right.
More often not, but sometimes yes. And so but it's just getting through this mindset of there's always a new paradigm where
well, I think that gets clicks, that gets people's attention.
Yeah.
That sells on the internet.
That's the way headlines are written. It's also you wonder why amateur investors, underperform markets. Part of the reason is all of these screaming headlines talking about new paradigms and Hindenburg omens.
Yeah, it really does people a disservice. The financial media, for the most part, does people a disservice.
Yeah, they're not there. They're there to gather clicks and eyeballs, and they work hand in glove with the financial services industry, who is like yes, we want you to get the clicks and eyeballs so that you can look at these ads that we're putting on there. And by the way, we'll appear on your programs and give you some content, and you can interview us, and then people will come to us. It all works together, but it really is mostly entertainment, because the amount of financial information that is meaningful that comes out every day is probably 2 minutes worth.
And for the listeners, when Frank talks about the financial services industry, he frequently plays a clip from Glengarry Glen Ross, which is Alec Baldwin saying, "Always be closing."
Always be closing. Only one thing that counts in this life. Get them to sign on the line, which is dotted.
Yeah, it's a brutal speech. I've seen that movie. Definitely wouldn't fly in 2023, but
it's what still goes on in the sales-oriented side of financial services.
100%. Very accurate portrayal of the psychology there.
Either produce or get out.
So before we wrap up, I have one last question. So what is something you would say to, say, a Gen Z person graduating from college who wanted some basic financial advice? What would you say to a person like that?
Well, you could go listen to podcast episode number 208, where I did a Wizard of Oz themed.
Oh yeah, that was good. That was good.
Advice for the beginning investor. Paul Merriman had asked me if I had anything to present to somebody like that. And at the time, I said, no, I really hadn't done anything, but I'll create something. So there's that. But really, I think the investing part is not very important when you're starting out. Mm-hmm. That you literally only need one fund if you want to go with that. A nice total market fund or S&P 500 fund, because you need to get in the habit of investing. And this is going to take time. It is like paint drying, because of the way that this works. That exponential curve, it's very slow and low at the beginning, and you only start getting interesting results out of your investments after you've accumulated something. And that number is about $100,000 for most people, that you really are not going to see much of anything going on with your investments until you get to $100,000 in your 401ks or wherever you're accumulating that. So I would just focus on getting in that habit and getting to that point, because in the meantime, we have all of this information out there about investing, and those basic principles that have been around for 15, 20 years now about using low-cost funds and using simple things and not getting caught up in a lot of complicated things that you're seeing on TikTok these days or anything else. All of that advice is still good advice and should be followed to begin with. So the procedure would be, all right, let's get regular investing going. Then while we got that going, let's go learn some things. And then we can come back and make modifications or change up things, because the other thing about it is what you put your money in the first few years, it's not going to matter. Even if you put it in a savings account and it didn't do anything for 3 years, it's not going to matter all that much, because it's just not that much money to start with. If you're talking about just an IRA, a nice portfolio, if you really want a portfolio that works well, that works better than a standard S&P 500 or total market fund, would be to put half of your money in one of those funds, total market, S&P 500, or a Vanguard or a large cap growth fund. VUG is the one I'm thinking of. Put half of your money in one of those, or some combination of those, it wouldn't matter. And then put half of your money in a small cap value fund. VIOV is one that Vanguard has. Another new kid on the block is AVUV, which is an Avantis fund that Paul Merriman and company recommend. And basically, they do a best-in-class funds review every year now. That's free, and you can look it up on the internet if you want to fund in a particular area. But if you have those two funds, you're fine. The other thing that I would encourage you not to do is do not use target date funds. Do not use target date funds, because they don't have what you want in them. And what they do is make you feel like you're doing magic with a black box, as opposed to actually learning about investing and why it works the way it does. A target date fund is a fund of funds. It has, depending on whose it is, it will have usually some U.S. stocks, some foreign stocks, some U.S. bonds, and some foreign bonds.
Well, you could usually build it yourself in your 401k allocations, get all the components much cheaper than the target date fund.
But usually you don't even want some of those components.
Yeah. Okay.
There's almost no reason an individual investor in the United States need to hold any international bonds. That's essentially a speculation on the value of the U.S. dollar. That's what it is. I like to call those the prison jumpsuits of personal finance. They are designed to fit everybody, so they don't actually fit anybody.
Okay. That's a compelling picture there. We don't want to wind up in the prison jumpsuits of finance.
Orange is the new black. And they were designed not for people who are paying attention. They were designed for people who do not pay any attention to their funds. Gotcha. Those were never intended to be the base vehicle for people paying attention to build out their portfolios.
And now they're the default option in most plans, right?
Yeah, those were invented as a default option for 401ks and 403bs, because prior to that, a lot of people just weren't investing their money.
Oh. So they would just stick it in a cash fund.
It would sit in there in a cash fund or some short-term bond fund, and it literally would not be invested for decades.
Oh, no. That's terrible.
And so around the early 2010s, this came out of books like Nudge by Richard Thaler and things like that. It's like, we need to make, what came out of that is like, all right, we need the default option for people getting jobs and signing up for 401ks is you are signed up for your 401k with some percentage going in there, at least getting matching funds and things. And then we need to have investments for brain dead people who aren't going to pick their investments.
Gotcha.
So that is who the target date fund is designed for. It's only recently that the financial services people that create these things go, well, here's a marketing opportunity.
Of course.
Look, it's got a name on it, and there's some kind of management going in there, and it's got this number, and you can match that to your retirement, and it doesn't it feel good to go in to buy this black box? And I don't mind so much the fact that they exist and they're a default option for people.
It's better than cash.
That's better than cash.
There's that.
What disturbs me more is that by using them, it confuses people about investing, and it actually interferes with their ability to learn about investing. Because instead of seeing their individual funds and seeing the performances, they just see this black box and stuff that comes out of it. And so it's like, I never learned how to cook because I always went to the kitchen and got a TV dinner on and heated it up. Gotcha. Okay. So I'm more worried about them from the pedagogical point of view. And, I've told my 20-somethings to stay away from them. And then when you're ready to retire and you know nothing about investing, you have no idea what to do. People get later on that you do not want set it and forget it forever. Because you are going to need to live off that money at some point. And you do need to understand what you're being bombarded with in terms of information and be able to distinguish good information from bad information. And so these ideas of limiting information, using black boxes, kind of magical thinking that the use of target date funds I see has led to is not helpful for Gen Zs or anybody else. Because then you get these weird ideas that, okay, what I really need to do is have multiple target date funds and combine them. People, as if there's some magical talisman to the 2060 versus the 2050. And the people that are doing this don't know what's in them. And they're like, well, I want to be more aggressive. It's like, okay, take the thing apart. You can do it yourself. This is not rocket science. the idea that we need target date funds because this is so hard to understand. It's not hard to understand. That's the other thing. Is like personal finance is not mostly very hard to understand at all.
Well, the financial industry wants to make it hard to understand, so you need them.
Yeah. There's always, even look at the terms people use. It's in my mind, it's a method of infantilization.
Mm-hmm.
Why would you call something baby steps? Do we want to stay babies forever?
Right.
Maybe you want to hire some nannies to feed you or play pen.
Dave Ramsey got that idea from What About Bob, by the way. So,
yeah.
Richard Dreyfuss's character, who's very arrogant, has this book called Baby Step.
Yeah. It's condescending and a form of infantilization for an adult to be thinking about that. And then people are always come up with, for the financial services industry, they're always coming up with these labels of things. Mm-hmm. The minimum dignity floor for your retirement. Can't we just say baseline expenses like adults?
Dignity. Yeah, it sounds like you're Cinderella or something.
What is it? The go-go, slow-go, and no-go years. It's a very sing-songy thing. It's helpful in some respects, but a lot of labeling done by the financial services industry is done so you can tell nice stories about what you're doing. And it interferes with actual understanding by adults of adult things. so I can only speak for my own family, my own children, but we sit down, we talk about, no, this is how you do your taxes, this is why you do it this way. These are the things you can invest in. Read this book, the information's all there. It's not that complicated. I realize it's kind of overwhelming because there's too much of it. But these days there are a lot of good podcasts. And if you listen to something like Choose FI, or they have like a free course, those guys have really tried to democratize financial concepts for people. And there are a lot of sort of good, positive actors out there. You do have to take some interest in it. The classics like, A Simple Path to Wealth are fine, but there are 16 different books that say the same thing. Every year there are five new personal finance books written by old guys like me.
He does it in a very unique way, though. I like the way J.L. Collins presents it. I think it's one of the better ways.
That's why it's a classic.
Yeah.
There are many imitators.
Fair enough. Yeah, there's a lot of books that do say the same thing.
There are many imitators, but that was written for his adult child who was not interested in finances. And honestly, that's what my podcast was originally for, was simply to lay out some concepts and ideas so that when I get hit by a bus, they can listen to them, because I'm tired of writing things down. I'd rather just talk into a microphone.
Gotcha. Cool. So before we wrap up, what are the best ways for people to learn about you and reach you?
You can listen to the podcast. Risk Parity Radio is the name. There is a website, riskparityradio.com, where you can go. And people email me all the time out of that. You can email me at frank@riskparityradio.com, and that's Parity, not Parody. The other place I tend to hang out is in a couple of Facebook groups. One is called Taxes and Retirement, run by Andy Panko, or I think it used to be. That is the old name. And then the Choose FI group on Facebook is also where I tend to hang out and comment and answer people's questions. I've tried not to do too much more because I don't really want to turn my podcast or anything into another job. It's important to me that it's not, that I don't have anything to sell. It's basically open source personal finance. I do have a charity that I'm on the board of called the Father McKenna Center, which I pump on my podcast. And you can learn about that there. But I'm hoping to be just one more voice of somebody who is interested and wants to share this kind of information broadly with whomever is interested. And most of the people on my podcast are beyond the preliminary things, and they've already accumulated lots of money and have lots of investments. But I do get questions from people at the beginning of their journey, and I'm happy to address and answer those as well. I don't do Twitter, sorry.
You're better off. I'm addicted. You don't need to be addicted to
well, I used to do Twitter and then realized, this is probably not serving me, because I don't have a business that needs to be promoted on Twitter. Twitter, I think, is very good for people that have businesses or other things that they are wanting to promote. And there's a lot of good and interesting people and information there, but I only have so much time.
Good decision. All right. Well, thank you for your time.
Thank you. This was fun, and I'm always happy to drone on and on about this. I could talk all day. Like a boll weevil sitting on a stone, praying to a dog in heat.
Right.
Thank you for listening to today's podcast. For more information, please go to securityanalysis.org. Subscribers to the website get early ad-free access to podcast episodes in addition to weekly in-depth profiles of companies.